Welcome to TP Talks, PwC's Global Transfer Pricing podcast series. My name is Dana Hart, and we welcome you to our next episode where we will address the transfer pricing implications of the new Section 174 regulations. Joining today's podcast, I have Marco Fiaccadori. Marco is a transfer pricing principal in PwC's US National Tax Services practice. I also have Dennis Tingey. Dennis is a tax services partner with PwC US. And last but not least, I have Erin March. Erin is a transfer pricing principal with PwC US. Erin is also our moderator for today. So Erin, I'm going to hand it over to you.
Great. Thanks, Dana. And thanks for having Marco, Dennis, and me here today. Obviously, Section 174 continues to be a hot topic. It kind of snuck up, I think, on a lot of people in the beginning of 2022. And we are very much in a wait and see moment now. Obviously, there's been attempts to have legislation passed that would amend the new Section 174 in Congress. Previously that was under the Build Back Better bill. Obviously, that has not yet passed, and there are maybe some other pieces of legislation coming up later in the calendar year 2022 where this topic could be potentially addressed. But the one big uncertainty remains timing. Exactly when would legislation be passed that would reverse the new Section 174, which of course approaches mandatory capitalization. So given the uncertainty, we're starting to see a lot of companies needing to get their arms around this new requirement, what mandatory capitalization of research and experimental costs or R&E expenses mean for them. Today on this podcast, we're going to address some of the TP or transfer pricing related questions and issues that we're seeing pop up as a result of the Section 174. But before getting into that, maybe Dennis, I could pass it on to you. And perhaps you could just start for us to give us a brief overlay on the new Section 174 and what it entails specifically for U.S. taxpayers.
Thanks, Erin. And you're right. This has been a very big topic. And maybe just a little bit of background, even before the legislative changes that came with the Tax Cuts and Jobs Act. As 174 is generally a provision that historically has allowed expensing of R&D costs. If you look at the legislative history before the new provision was enacted, Congress had decided that they didn't want controversy in this area as to whether a taxpayer could deduct research and experimentation costs, and they wanted to encourage research and experimentation costs. And so the rules before the TCJA were very favorable to taxpayers. Taxpayers could choose to expense anything that was related to software development or anything that was related to research and experimentation. They would have the ability to capitalize if they wanted to. And so lots and lots of flexibility. And then what we have is the issue that everyone's wrestling with today, which is under the TCJA, as part of those provisions and as part of a pay for, a provision was enacted that mandates capitalization for not only research and experimentation costs, which was what 174 specifically referred to historically, but also for any software development cost. And the way that the law works is that capitalization is mandatory for any cost that software or R&E that's incurred after January 1st this year. And that capitalization is then recovered either over a 5-year or a 15-year period of time, depending on whether those costs are domestic or foreign. And so what it's left us with is this really big uncertainty as to, how is this provision to be applied? It's effective today. Lots of people thought it would never become effective, and that's one of the things we're wrestling with. We have very limited guidance from the government at all about the new provision. And so we're just kind of sitting here saying, hey, we have a fundamental change from what the law used to be. It's now become effective and is applicable to costs that are being incurred in this tax year. And where does that kind of leave us? And so that's the state of where we're at in the background of what people are wrestling with today.
Great, Dennis. Thanks for that additional background. Good to just kind of set the stage here as we delve in more deeply on some of the issues when it comes to 174 in general, as well as some of the transfer pricing implications, in particular intercompany transactions. Dennis, curious, I see a lot of companies, are releasing their Q1 earnings over the past few weeks here, and was curious, what did we see pop up in terms of some of the issues or questions that taxpayers had when they were working through their first quarter provisions this year, knowing, like you had said, this kind of snuck up on us, perhaps?
Yeah, Aaron, I think that's a great question, and it's really interesting because of provision scene. We're seeing issues that we had thought a lot about this before, but just issues are popping up everywhere in oftentimes unexpected ways. I think one of the biggest issues that we're seeing is that because the prior law was so taxpayer favorable, taxpayers really didn't need to decide whether something was a research and experimentation expense or just a normal trade or business expense, that they were both going to be deductible. There wasn't really any need to identify those. Now that you have this mandatory capitalization provision, one of the big issues that's coming up is just what is for sure a research and experimentation expense and what is a software development expense. And how many costs need to go in that? Is it just for employees? Is it for rent? Is it for indirect costs that might get pulled into that? Do you have to have a research intent? Is it just writing software code? Is it something more than that? Does it need to be an ownership type based test? And so just all kinds of issues surrounding how do we actually define what a software development cost is and how do we actually define the scope of what an R&E expenditure is. Again, under the old law, that wasn't really necessary because you had this flexibility built into the provision. Software development in particular is something that before, the way that the law had worked is the IRS had said you can treat software development in a very flexible way, just like 174, but there was no direct guidance as to what the distinction between the two was. Now that software development is expressly provided in the code to require capitalization, that's been another area is to try to say where are we going to look for guidance as to what constitutes a software development cost. The other things that we're seeing is just a lot of residual impacts, which is okay, once you start capitalizing amounts and that can change your taxable income, what effect does that have on all kinds of other provisions? So there's provisions like guilty and beat and other state tax provisions where the amount of taxable income you generate or the characterization of a cost becomes relevant. And we're seeing some overlay in that area. And then on top of that, you have other provisions that have expressly sort of been tied to 174. You have certain sort of allocation provisions that reference 174. You have election provisions like under 59E that would apply to 174 costs that are deductible. You have certain rules in the cost sharing arrangements that might have applicability there. You even have state tax apportionment issues that can have relevance as to whether the state adopts the new provision or not. And so overall, just lots and lots of issues. There's always been an interaction with 174 and the research credit. And again, the list just keeps growing as people start digging into this more and more. And I think you said it well, Aaron. I think people have kind of put this on the back burner, thinking that it would never become effective, and yet here we are. And as people wrestle with that, that list continues to grow.
Thanks, Dennis. That's definitely quite a list. I think, like you had said, sort of those residual effects or those knock-on effects. It's almost a scenario where you don't appreciate all of those until you start working through it, understanding what it means to you, and then what's the materiality of that. Knowing obviously that we're in transfer pricing, a lot of our intercompany transaction are really impacted and closely correlated to other international provisions. And here, Dennis, I'm thinking things like guilty and beat, for example. Maybe we can probe into those international provisions and some of those knock-on effects we're seeing on 174 a little bit more. Again, I think that's maybe something that a lot of taxpayers may not fully appreciate up front, but then start to see that there. So perhaps, Dennis, we could probe into those a bit more.
You bet, Aaron. And I think, again, in my practice, in our world of methods and accounting periods, we generally are focused through a domestic lens. And Section 174, is in our mind quite often viewed as a domestic issue. What we found as that we've started to pull this apart is how much crossover is in other areas, particularly the international area. So anytime there's a characterization issue, so for example, under BEAT, you think about whether intercompany sort of transactions related to R&D services can have an impact there, and which affiliate's going to have to capitalize, how that's going to impact their particular taxable income. We're seeing a lot of really interesting issues there that are just hard to get your hands around unless you start modeling out the impact. The other thing is different provisions like 163J and other sort of limitations that are based on taxable income. Well, taxable income is going to change dramatically in terms of projections and modeling, depending upon whether you have to capitalize your software and your R&D cost or not. And interestingly, some of those times capitalization can be actually favorable, and taxpayers may want capitalization depending on their unique sort of international posture and the things that they're wrestling with. again, whether it's 163J or whatnot, there's FDII sort of characterization, benefits and impacts, and people looking at those kind of things. Again, looking about build back better and what provisions might be revoked in the future or changed in the future. You might want to capture a certain benefit, and 174 might have an overlay there. Your guilty profile is definitely being impacted depending on whether or not you're going to have to capitalize these in different jurisdictions and whatnot, and how that will sort of play out. And then you have definitely, like we talked about, some very specific provisions that specifically reference Section 174. For example, in the 861 regulations, there's very specific allocation and apportionment rules with respect to R&E expenditures and how they're characterized. There's also other places of the code where 174 expenses are specifically given a certain treatment, like 263 Cap A and other provisions. And I think modeling becomes very, very important.
Yeah, maybe Dennis, pivoting. I know we unpacked a lot there, and definitely, like you said, it's not a one size fits all. The one thing that jumped to mind is when you were talking about guilty and how we think about income in other jurisdictions, and when we think about common intercompany transactions that we see a lot of taxpayers have. One that kind of comes up to the list, thinking about guilty as well as the BEAT considerations that you were mentioning, is contract R&D arrangements. Dennis, I think maybe you had talked slightly earlier on about the amortization of costs, and maybe just before we delve into the contract R&D, just to level set again, can you tell us how we think about amortization under Section 174, dependent on the location of where R&D activities are being performed?
Yeah, Aaron, one of the things that's relatively clear in the new statute, but we've had a lot of questions on, is how do you distinguish between the 15-year amortization for international sort of R&D cost versus the 5-year amortization that's for domestic R&D cost? And it may not be entirely intuitive, because a lot of times taxpayers are looking at who the payor is as opposed to where the activity is actually occurring. The way the statute works is that really it's based on where the R&D costs are being performed, the activities are being performed. So if there's costs being performed, outside of the U.S., those costs will generally get a 15-year amortization. If there's costs being performed in the U.S., those will generally get a 5-year amortization. It's not necessarily who the payor of those costs is; it's really where the activity is occurring, and that can have some really interesting, situations where you have someone who might be in one jurisdiction but is getting a very different amortization because of where the costs are being incurred.
So maybe Dennis, building on that and thinking forward on, contract R&D, just curious, what positions have we seen taxpayers taking and adopting on this? For example, a lot of US-based MNCs have foreign entities performing contract R&D. And when we think about locations of where activities are being performed, and then applying sort of our traditional transfer pricing lens on this, thinking about entities that, fund the R&D costs and own the underlying intangibles, maybe what positions have we seen companies take when it comes to 174 in the context of contract R&D? Exactly which party should be amortizing these costs?
Well, or maybe even the question is, should both parties be amortizing the cost? It seems non-intuitive, and there's really, other than what actually is an R&D cost, I think this contract research arrangement and cost sharing arrangements have probably been the biggest issue that taxpayers have been wrestling, and practitioners have been debating under the new statute. And I know Marco is going to talk to us a little bit about, specifically some cost share issues. If we just start with the base case of when we're contracting, whether it's with a related party or with a third party to do research on our behalf, one of the big questions that are sitting out there right now is whether the idea of a 174 cost is really only applicable to the person who owns or controls or benefits from the end IP from the research, or whether it's really more of an activity based test, meaning that anybody who engages in research activities, whether you're doing it on a contract basis or whether doing it on your own behalf, would be required to be capitalized. And the current regs are just very, very unclear here. If you view it as an activity-based test, then you have a situation that people are really concerned about, which is you might have double capitalization, meaning that if I paid a related party $100 to perform research services on my behalf, and then that affiliate goes out and pay their employees $90 to do the research with a 10% markup, all of a sudden you could have a situation where I, as the principal, I'm going to capitalize $100 of R&E cost because I'm paying someone to do R&E on my behalf and I own the IP. But then the service provider also will have to capitalize that $90. And now you've got $190 of capitalized R&D costs when there's really only 100 cost in the system. And that sort of stacking or double capitalization would be the result if the regs are interpreted as an activity-based test. In alternative, if you did it more as an ownership-based test, then I think it's relatively clear that only the principal who owns the IP and is benefiting from the research would capitalize, and the service provider would effectively just deduct those as normal 162 expenses. But this is a very big open question, a lot of debate as to what people think under the current law that the answer would be, because we to date haven't gotten any real guidance from the government. But this question of activity versus ownership-based test is a really, really big question, and probably the one that people have been wrestling the most from a provision standpoint.
Thanks, Dennis. That's helpful. And, it's not only the numbers when we think about that specific impact of that transaction, again, that R&D service recharge, but then again, going back to those knock-on effects, what does that mean in terms of your GILTI income, for example, or your BEAT position for those US taxpayers? So I guess now that we've got the contract R&D arrangements, or at least some of the issues we're seeing popped up there covered, Marco, maybe pivoting to you, was curious if you could help us understand the interplay of Section 174 capitalization and the cost sharing regulations under Section 482. Obviously quite a complicated area. Could you maybe walk us through some of the key issues and implications that we see popping up for taxpayers?
Sure, Erin. And I would note first that R&D capitalization is just bringing a number of uncertainties for U.S. companies, for U.S. taxpayers, with cost-sharing arrangements, whereby they want those cost-sharing arrangements to meet the requirements under 482-7, which is a fairly prescriptive set of rules in our transfer pricing regulations. And those regulations were written at a time where R&D expenses and 174 expenses were in general currently deductible. So they're not really necessarily easy to interpret under the current framework. So, letting aside the 174 identification, assuming there is 174 expenses as in the pool of intangible development costs, there are really two big questions that arise in this context. One is relating to the measurement, and in particular, specifically to the stock-based compensation amount that is intended to go into the calculation of the intangible development cost in that year. And the other is about the netting, or making whole each other cost-sharing participants by virtue of the cost-sharing transaction payment. And this payment, the recipient of this payment, there are different ways of interpreting the rules in how to account for it, in how to treat the receipt amount, in particular from a U.S. recipient in the U.S. return, but also potentially for a CFC in the other direction, to the extent the cost-sharing participant is a CFC. So why would it goes beyond the scope of the podcast to go through the complications. I would say sort of the issue, the core issue, is somewhat of ordering, and whether 174 really applies before some of the mechanical applications of the rest of the 42 rules. Specifically, for the stock-based compensation question is whether what should be shared is just amortization relating to the amount that has been first capitalized, versus the sharing is the cost that is incurred, and the 174 comes later. So in effect, maintaining a position that the cost-sharing participants would instead measure the cost first and defer sort of the 174 capitalization, and therefore also the amortization of the capitalized amount later. Similarly, for the cost-sharing transaction payment, in questions on interpretation, whether the recipient of the cost-sharing transaction payment would be effectively forced to recognize a reduction in its own deduction, and potentially even an inclusion of income by receiving the cost-sharing transaction payment, or the receipt of the cost-sharing transaction payment reduces the amount to be capitalized to begin with, and therefore reduces also the amount of amortization and deductions associated with it. At this point, taxpayers have, developed several arguments in favor or against either positions. And I would say it's because it's fairly prescriptive is something that we see as important in both in modeling alternatives and also understanding the potential pitfalls of one or the other arguments, knowing that there may be also fact-specific items, not just the regulations, but the fact pattern and the history of the taxpayers in taking alternative position or position that could limit the ability to choose a particular interpretation in this context. So something to navigate and something to consider specifically for those taxpayers that have a material amount of 174 in their pool of cost sharing.
Thanks, Marco. Definitely a complicated area and a complex area, both when we think about the treatment of those stock-based compensation costs, and then, like you had said, the interplay between 174 eligible costs and the mechanics of the cost-sharing transactions that we have in cost-sharing arrangements. Maybe before we sign off here today, curious, Dennis, Marco, what some of the key takeaways would be for listeners, if maybe we could perhaps just recap on that, given we've definitely covered and unpacked quite a bit here today, and maybe unpacked isn't even fair, more touched on a lot that definitely could be unpacked further on the podcast here today.
Yeah, Erin, I think from my perspective, and Marco mentioned it as well, I think one of the big takeaways is just how uncertain this area is right now, that there's a lot of reasonable ways to look at these provisions, whether it's the cost sharing rules, whether it's the contract research, whether it's the scope of 174 just in general. And there's good arguments to say that whatever the rules become finalized, if they ever do become finalized, they could go either way. And so I think it leaves taxpayers both with some flexibility to be reasonable in the way that they're looking at these rules, but also with a lot of uncertainty. We just don't know. We don't have any guidance from the IRS, notwithstanding the fact the law has been out there for 4 years or so. We don't have any help because I think policy-wise, people really do still think the provision will likely be, deferred or revoked at some point in time. And yet the law is what it is today. And so I think the takeaway is that there's just not answers to some of these questions. There's some good, rational, good thinking behind it. We hope that the government will help us here a little bit at some point, or that the provision gets revoked or pushed down the road. With respect to the legislative environment, I think people were hoping something would have been fixed before now, and we're not in that environment. I think given the current political posture and the elections coming up, that there's just a good chance that nothing legislatively happens, here in the near future. And that too creates this uncertainty that you're going to have to deal with and try to model and think about these things, notwithstanding the fact that there's a lot of uncertainty and we really have almost no legislative or administrative guidance, from the government. And so through the rest of the year, I just think taxpayers are going to have to wrestle with this, both from a provision standpoint, an internal modeling standpoint, because as of today, this is the law until we get some more definitive guidance or there's a legislative change.
I echo your thoughts, Dennis, and I would emphasize that for the taxpayers that have already done some work because of provision to keep these monitoring closely and continue to work with their advisors and auditors sort of to maintain that course of action and the course of navigation in real time. And for others that perhaps have pushed back, it is now time to reconsider whether this is something that needs to be reprioritized given the chances that we're not going to get clear resolution or there will be a turbulent time. And at one point, possibly, the taxpayers will no longer have the ability to defer this beyond, probably the fall. So something that needs to be built into the schedule at this point as a contingency for the tax department to tackle on or to continue to monitor if this has been already discussed.
No, definitely a lot to think through and just stay close to. Definitely both Dennis and Marco when it comes to legislation, but just more procedural, getting our arms around it and what it means for individual companies and the potential ramifications given where we stand now from a legislative perspective. So I know we definitely touched on a lot of points, more to unpack for sure on this topic. But with that, just wanted to thank both Dennis and Marco for joining me today. And a big thanks to our listeners as well. We hope that this discussion was insightful and at least gave you a flavor of the various topics and considerations there are to think through in the context of Section 174 and the potential impact and implications to common intercompany transactions. Of course, stay tuned for future TP Talks podcasts, and we hope to see you back here soon. Thanks for your time.
This podcast is brought to you by PwC, all rights reserved. PwC refers to the U.S. member firm or one of its subsidiaries or affiliates and may sometimes refer to the PwC network. Each member firm is a separate legal entity. Please see www.pwc.com/structure for further details. This podcast is for general information purposes only and should not be used as a substitute for consultation with professional advisors.